Imagine it's a normal weekday morning. Your alarm goes off, you reach for your phone, and before you even stand up, you already owe money, not because you bought anything today, not because you made a mistake yesterday, but because the modern economy now charges you simply for continuing your life. Your rent is due, your car payment is scheduled, your phone bill is pending, your insurance autodraft is coming, your student loan balance is still there, quietly accumulating interest. You haven't failed, you haven't overspent, you're just participating. This feels normal now, but it didn't always. There was a time when wages paid for life. You worked, you earned, you spent, and what was left was yours. Today, wages don't pay for life. They only qualify you for credit. That is the shift most people never noticed. In the decades after World War II, the system was simple. One income could support a household. Housing costs were tied to local wages. Education didn't require decades of repayment. Healthcare existed, but it didn't follow you home as lifelong debt. Debt existed, but it was limited. It was something you used occasionally, not something you lived inside. Credit was a tool, not the foundation, but that system had a ceiling. When wages rise with productivity, workers gain purchasing power. When workers gain purchasing power, profit margins eventually compress. There's only so much value you can extract from a paycheck. Credit removed that limit. Credit allowed spending to grow even when wages didn't. It allowed lifestyles to expand without raising income. It separated consumption from earnings, and once that separation happened, there was no going back. The change didn't arrive with an announcement. It arrived through convenience. In the 1970s, productivity continued to rise, but wages flattened. Workers were producing more value, but they weren't being paid proportionally more for it. At that moment, the system had a choice: increase wages to match productivity, or find another way to keep the economy growing. The answer was debt. Credit cards expanded rapidly. Mortgage terms stretched longer. Student loans became normalized. Healthcare moved from upfront cost to long-term billing. Every step made life feel easier. Every step made debt feel harmless. Instead of asking, "Can I afford this?" people were trained to ask, "Can I get approved?" Approval replaced affordability. A $40,000 car didn't feel expensive if the monthly payment fit. A six-figure education didn't feel dangerous if repayment started later. Medical bills didn't feel catastrophic if they could be financed. Monthly payments softened reality. Credit doesn't remove cost, it delays it and delays it and delays powerful. Entire industries rebuilt themselves around this logic. Housing prices could rise faster than wages because loans got longer. Education costs could explode because repayment was postponed. Healthcare prices could surge because insurance and financing obscured the bill. Wages didn't need to increase anymore. Credit would fill the gap. But credit always carries a condition. It must be repaid. Debt is not just money you owe. It is labor you have already promised. When wages stagnate and debt grows, future work is pre-sold. You are working today to pay for yesterday, and tomorrow is already spoken for. This is why modern workers feel trapped even when employed. Every paycheck arrives already divided. Rent, loans, interest, insurance, minimum payments. What looks like income is already assigned. This creates a quiet contradiction. Economic growth looks strong on paper, but people feel financially exhausted, not because they're irresponsible, but because they're leveraged. The system shifted risk downward. Credit transformed workers into long-term revenue streams, not just for banks, but for nearly every sector. Education profits over decades. Healthcare generates recurring billing. Housing creates lifetime mortgage customers. Transportation becomes a subscription. One-time ownership gave way to permanent obligation. Wages are limited. Credit can always expand. That's why credit replaced wages. And once enough people depend on debt to survive, wages can't rise easily anymore. Higher wages risk inflation. Inflation threatens asset values. Asset values support the entire system. So instead of raising income, the system lowers interest rates, extends terms, offers deferrals. Every solution deepens dependence. As long as income remains stable, the machine runs quietly. But credit only works when nothing goes wrong. The moment income is interrupted, everything shakes. Missed payments cascade, fees compound, credit scores drop, access disappears. When wages supported life, disruption was survivable. When credit supports life, disruption becomes systemic. And that is where the real risk begins. Because once credit becomes the foundation, the system stops being flexible. It becomes brittle. Credit assumes continuity. It assumes tomorrow looks like today. It assumes jobs remain, markets function, payments clear, and confidence holds. It assumes that income will arrive on schedule and that nothing interrupts the chain. But history shows that continuity is rare. Every major financial crisis begins the same way, not with panic but with comfort, with stability, with the belief that the system has matured, that safeguards are in place, that risk has been managed. And every time the trigger looks different, a market crash, a housing slowdown, a banking failure, a sudden rate increase, a global shock, different causes, different narratives, but the pain always lands in the same place, on people whose lives are financed. When credit replaces wages, even small disruptions become dangerous, not because people are reckless but because the system leaves no room for error. Debt doesn't pause when income does. Interest doesn't understand emergencies. Bills don't wait for recovery. They arrive on time. This is why modern crises feel personal, immediate, and overwhelming. They don't stay abstract. They show up at the kitchen table, in email reminders, in overdraft notices, in quiet anxiety late at night. In older economic systems, downturns unfolded slowly. Spending tightened, businesses adjusted, households cut back. There was friction, but also slack. Today, slack is gone. A missed paycheck doesn't mean inconvenience. It means delinquency. A temporary disruption doesn't mean delay. It means default. Because when life is financed, time itself becomes a liability. This is the hidden cost of credit-based living. The system appears resilient because it grows smoothly during stable periods, but growth hides fragility. The more debt expands relative to income, the less shock the system can absorb. This is why financial crises now feel inevitable rather than accidental. They are pressure releases. They are moments when accumulated promises collide with reality. Credit builds tension quietly. Every loan is future demand pulled into the present. Every financed purchase borrows stability from tomorrow. Every monthly payment assumes continuity that has not yet happened. Eventually tomorrow arrives and it cannot pay for yesterday. When that moment comes, the system doesn't fail evenly. It never does. Those with assets survive volatility. Those with liquidity buy opportunity. Those with leverage absorb impact. People don't lose because they took extraordinary risks. They lose because risk was embedded into ordinary life. Housing shows this more clearly than anything else. Homes stopped being places to live and became financial instruments. Prices rose faster than wages for decades, not because shelter improved proportionally, but because credit made higher prices serviceable. Longer mortgages, lower initial payments, refinancing cycles, variable rates. Each innovation allowed prices to rise without raising affordability. Ownership became conditional. You didn't own your home, you serviced it. As long as income flowed, everything looked stable. Equity numbers rose. Balance sheets looked healthy. Confidence grew. But when disruption came, job losses, rate hikes, tightening credit, the illusion cracked. Foreclosure isn't caused by moral failure. It's caused by leverage meeting interruption. The same structure appears everywhere credit dominates. Education promised future opportunity, financed with debt in the present. The assumption was simple. Higher earnings later would justify the obligation now, but earnings were never guaranteed. Only repayment was. Healthcare promised survival, financed without meaningful price limits. Costs expanded because payment was abstracted away from the moment of decision. Transportation promised mobility, financed monthly. The vehicle mattered less than the payment. Across sectors, the pattern repeated. The system assumed future income would always justify present obligations. That assumption is fragile. And when it breaks, consequences cascade. Credit markets tighten. Lending standards harden. Access disappears. People who relied on refinancing suddenly can't. Those who lived on minimum payments face full balances. Those who never had savings discover there is no buffer. This is when the hierarchy becomes visible. Assets are protected first, institutions second, individuals last, not because of conspiracy but because of design. The system is not built around human stability, it's built around financial continuity. This is why policy responses often feel disconnected from lived reality. Interest rates are adjusted, liquidity is injected, markets are stabilized, but household pressure remains, because stabilizing credit doesn't stabilize lives. It stabilizes balance sheets. Balance sheets don't feel stress. People do. This creates a psychological fracture that defines modern life. People are told the economy is strong, markets are up, indicators look healthy, yet personal anxiety increases. Not because people are irrational, but because the metrics measure credit health, not human capacity. A credit-based economy can grow even as its population feels poorer. That's the paradox. Growth no longer means relief, it means maintenance. People are not building wealth, they're preventing collapse. And this is why every crisis feels familiar, even when the cause is new. The structure hasn't changed. Only the trigger has. In every cycle, Debt expands during calm periods. Leverage feels safe when volatility is low. Risk is underpriced. Then something shifts. Rates rise. Confidence weakens. Cash flows tighten. Suddenly, obligations that felt manageable become suffocating. And people ask the same question every time. How did this happen so fast? The answer is uncomfortable. It didn't. It built slowly. The crisis is just the moment the math becomes visible. Credit hides strain until it can't. That's why recoveries increasingly focus on restarting credit rather than raising wages. Lower rates, extended terms, payment pauses, emergency facilities, temporary relief that restores flow without fixing structure. Because fixing structure would require confronting the core issue. Wages no longer anchor the system. Credit does, and credit demands growth. If growth slows, defaults rise. If defaults rise, institutions weaken. If institutions weaken, intervention follows. The system becomes circular. It cannot shrink without pain. It cannot grow without risk. So it oscillates: expansion, stress, intervention, repeat. Each cycle leaves households more indebted, not less. Each recovery resets stress slightly higher. This is why people feel like they're running faster just to stay in place. Because future income is constantly pledged to maintain present stability, there is no room for resilience. Resilience requires margin, savings, flexibility. Credit removes margin. It replaces adaptability with obligation. That's why the system depends so heavily on confidence. As long as people believe tomorrow will be fine, payments continue. As long as payments continue, institutions remain solvent. As long as institutions remain solvent, confidence holds. It's a closed loop. Break the loop, and everything accelerates. This is what makes modern crises feel sudden and overwhelming. Not because problems appear overnight, but because leverage compresses time. Years of imbalance resolve in months. Months resolve in weeks. Weeks resolve in days. What used to unfold gradually now collapses quickly. And the damage doesn't require total collapse. Stress alone is enough. People adapt defensively long before failure. They delay milestones. They avoid risk. They accept instability as normal. An entire generation grows up managing debt instead of building security. Not because they lack discipline, but because the structure leaves little choice. Even success becomes fragile. A good job supports obligations rather than freedom. A raise disappears into higher servicing costs. Progress feels temporary. This is the emotional signature of a credit-dominated system. Persistent tension without resolution. Hope without slack. And the longer this persists, the more normalized it becomes. People stop expecting stability. They plan around fragility. That's the quiet shift no statistic captures. Credit didn't just replace wages economically. It replaced certainty psychologically. Life became something to manage, not something to secure. And until that reality is acknowledged, financial crises will continue to arrive with new explanations. But they will always feel the same, because the pain is not caused by the trigger. It's caused by the structure that makes every trigger catastrophic.